Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard. We are coming to you from the Star in Frisco, Texas.
That's right. The home of the Dallas Cowboys. We love them when they're good and hate them when they're bad, right?
And that's the way it always is.
Right. We just got the results in.
Thank you very much.
For the show, number of listeners and all that stuff. And just to let everybody know a brief history, we've been on the air here for, 20-something years.
20-some years.
We were off briefly a little bit last year, but we've always had the number one listened to financial show until about a year and a half ago.
Some
a
big
national person,
syndicated person,
right, came in and
knocked us off.
So the news is in. We knocked him off this time. So number one across all stations, all talk show, anything but unless it's a music or sports station, which is different, not our genre.
And which is a big deal.
Oh yeah.
And we thank you guys for listening. I tell everyone, we do the show. It's kind of a hybrid. We try to be consumer advocates. Try to warn everyone from the unregistered life settlement investments, some of the commercials that you hear that say if you're going to invest in an IRA, don't. Our investment beats the pants off of it, stuff like that. But also we do this, we're wealth managers. And like Victor said, we've been doing the show for about 20 years, but we've been in the business here for 30. Victor and I have worked together since 1990, give or take a year or two.
Just tell them how old we are. Be careful.
I'm careful. But here's the thing. We have not had a complaint in 30 years.
Right. That's really good.
In this litigious society, it's a real big deal. So.
Oh, yeah. Absolutely. A lot of it, like I said, I think some of the popularity with our show is we'll just tell you like it is. We're not going to recite the Greek alphabet, try to explain to you the standard deviation, the alpha, the gamma, the beta. It's just most people don't understand it. Brokers use that kind of language to make themselves sound smarter.
That's right.
When they could have just been regurgitating that from a thing they just read. And so we're trying to see what's the most important. When we base everything on math, I don't like sales pitches. I don't like being sold anything. But if mathematically another strategy works better than your current strategy, that's when we're going to show it to you and show you why mathematically it will continue to work.
And we've talked about that before. Psychologists, economic professors will tell you the number one reason to have an advisor is because it takes your emotion out of it and boils it down to mathematics. When people bring us portfolios, think about it. If you came to visit us the first time, it's kind of a quote, kind of a get to know each other. We get to kind of go through where you are. And I can't tell you how many times on the good side that we'll go through things and someone will have a teacher retirement or a pension based on old actuarial tables. That's really good. And we'll tell them it's really good. You need to stay with that. And then on the other end of the scope, we'll have people come in with variable annuities that have high fees and don't have the right benefits, or will have, a few $100,000 account and 40 different mutual funds. And these managers don't check with each other when they make trades, right? One's buying Apple, one's selling Apple, so they're not working in unison. But the point is, if you have a good program set up, we'll be the first to tell you and encourage you.
Right. It's by not getting every piece of business that's out there. People ask me, no, I want you to work with it. And I say, no, it actually is better, your best interest to stay where you're at. Those kind of honest kind of approaches to looking at a portfolio, I think, is one of the reasons we haven't had a complaint in, our combined 65 years experience or whatever.
I'll have them ask me after we tell them to stay where they are. Well, what do I owe you? What's your fee? And right. I have a standard issue answer for that. And my answer is, next time you hear someone say, I need help with my stuff, do you know of anyone? You say, absolutely. You call the guys over at McClure Capital. They'll take care of you.
That's right. It used to be about 50-50. It's a little bit different now, but it's about 50% of the time I say, I can't do much for you. You're better off here. Like, let's say it's a situation where I have a minimum on a managed account for size-wise.
Right.
And I'll tell you, I can take any amount, but if I did the fees, because there's a minimum charge per account by Fidelity or whatever, because we're advisors at Fidelity, I'd say it's in your best interest to stay at Vanguard. And by the way, we love Vanguard. We love indexing. A lot of people say, why does an advisor like indexing? Because it's smart. It's low cost. You know, I like to do low cost things. Anytime you pay high fees, it's usually good for one side of that transaction, not the other side,
You're
not
right.
the person purchasing it.
Absolutely.
Right? And so you have to make sure when you're looking that you're getting unbiased advice. It is almost impossible to find anybody, a professional, that's not going to have some kind of bias. It's almost impossible. But you got to get as close as you possibly can. That's why I don't like proprietary products. In other words, if I have just this company and that's all I sell of these mutual funds or these annuities or whatever, well, every single solution to every single problem in the world is going to be this particular, fund or annuity, right?
And captive brokers are worse.
That's right. And a lot of them, they had an issue with the fiduciary, because how can you be a fiduciary for someone if you're offering them just one company's products?
Absolutely.
Right? And so that's why I don't like captive things. I like independent agencies. Even your larger firms, some of them are incentivized more to do their in-house products, or it's kind of an unspoken rule. In other words, they can't legally make them do all their products, but if you don't, you get fired kind of thing. It's kind of an unspoken rule. If you're up Maryland, don't sell them. I'm just picking on them.
I did not know.
Yeah. Any company, what it is. If you don't sell enough of that stuff, you could be fired.
You know how you always think what you do is the best?
Oh, yeah, of course.
I'm sitting here listening to you go through that. I'm thinking, we're biased. We're biased towards
Absolutely.
lower fees and safety. But I'm thinking that's okay.
Right.
It's funny. But we are biased, right?
That's right.
We try to get the
Everybody
lower fees and we try to lean towards safety.
Right. But the one thing is, just always think about the language. The language of advisors, it'll tip you off. I'll give you an example. Somebody says the stock market is a casino. You should never be in the stock market. Is just trying to sell you something else.
Yeah.
All right? Because the stock market is not a casino. Don't be wrong. There's some kind of gambling aspect to it, but it is actually ownership in things. There's not a time limit that runs out like there'd be a gambling or whatever. And so it's actually equity in something.
And
So
allocations are
right.
important, which we'll get to later.
Right. There is nothing wrong with the stock market. Anybody telling you shouldn't do the stock market, like I said, is just trying to sell you something else. They're not an advisor in my book any longer. Also, it matters conversely to that. Let's say they said you should never do an annuity. They're the devil's work. Only an idiot would do one. Or there's always a way to do it better.
Yeah, I was just
I've
thinking
heard
of the
those commercials a bunch
That's
of times, right? They're just trying to sell you something else. Because it's a legitimate investment, been around 100 years. There's nothing wrong with the stock market. There's nothing wrong with annuity. Now, if they're arguing specific types, like some variable annuities can have fees of over 5% a year. I agree with them 100%. That is a terrible annuity. But if you don't do those, you've got the other four types don't have any fees or to a maximum of 1% fee. If it makes your portfolio that much better, then it's something to consider. Regardless of the noise that comes out either way.
Good word.
You stay with low fees, stay with things that make sense mathematically. It is very difficult to not get a good sense of what it is. So when somebody brings us something to us, we don't say, oh my gosh, who did that to you?
Oh,
that's the
terrible.
worst mutual fund I've ever seen. Well, first off, here's what we think. This person agreed to this. So let's say we're trying to cut down an advisor, which we would never do.
Nope.
We basically
Oh,
just
maybe
told
once.
the person, that they're stupid as well because they bought the hook. They got the hook, right?
Right.
They bought something that was ridiculous. We'd never do that.
Sure.
What we say is we think our plan can be better because of this. This math is why.
If in fact it can be better, and here's how I explain it to a lot of people too. Advisors all have different opinions, and Victor talked about earlier biases perhaps, but we all have different experiences. We've all formulated our opinion based on our life experience in the industry. Victor and I have formed ours on 30 years. So it's a lot like a marriage, in as much as obviously you want the relationship to last a long time, but your philosophy needs to agree with your advisor's philosophy, whether he's a risky futures market trading guy, whether he's an all CD or bond guy or fixed annuity guy, whether he's a combination thereof. You need to share the same philosophy, and that makes for a better relationship. So in the conversations you have, or if your existing broker is doing some things that are uncomfortable for you, you may not be sharing the same philosophy.
Right. What you've got is, let's say an advisor says everything should be in stocks and bonds. That's okay. That's your opinion. They believe that is the best investment mix long run. and there's nothing wrong with having that opinion. But what if somebody says, well, I think you should only be in annuities or life insurance and you shouldn't have any stocks? It's okay, that opinion, but honestly, the better approach is maybe we should look at all these tools and how they come together.
Absolutely.
And what will happen is a lot of times, like we just looked at a couple of cases recently, that, hey, really, the annuity piece doesn't belong in there. This person does not need life insurance.
Or they've got too much of this or too much of
That's right.
that.
This should be more in the stocks and bonds because they got their income needs met, all these different things. They don't want to leave an inheritance. So all of those kind of things can come into play when we're looking at someone's portfolio. Don't forget, if you have any financial questions, call us at 972-715-2424. We'll be more than happy to look over your entire portfolio, answer any questions you might have. Again, 972-715-2424, or you can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
We need to update those bumpers, Guy. The number one talk radio show in Dallas, financial show in Dallas, period. And that's across all stations.
That's right. If you didn't hear the first segment of the show,
KRLD is the best station, obviously.
Well, would you listen to anything else?
That's right. But across all stations, our time slot, we destroy everybody. But I'm talking about all weekend shows. We are number one.
And we're not bragging. We're very proud of that. But you think about it. Remember when we were growing up, listeners and us, you'd have a radio in your kitchen, right? You always had a radio. Now, you just don't do that anymore. Really, to listen to the show, almost, you've got to be in your car traveling between noon and 1.
That's right.
Today, Saturday.
The good thing is a lot of people leave it at, they have businesses, place of business. Yeah. They leave it in the background because it's news and weather and all that stuff.
On the 8th, that's right.
So, all right, today's show.
We're going to share some secrets?
That's right. We're going to show the bucket strategy. You've heard us do little hints of it before, pieces of it. We're going to try to get through the whole thing and what is a bucket strategy. How do you implement it? What is the best things to put into your individual buckets? Okay.
Now, you can make this as complicated and as layered like an onion as you'd like. We've got this boiled down to keep it simple, and I can't express upon you enough or impress upon you enough how effective it is and what a big difference it makes once you get this right and you start rolling with it.
All right. We'll identify the buckets first. First, you've got to have a cash or emergency bucket. I can't
liquidity.
Talk you got to have liquidity is extremely important. Don't let anybody take all your money and make it illiquid. Don't put it all in a piece of a Galveston beach house or something like that because it's going to be tough.
Even some of these REITs that you hear about where they're promising you 7%, which you'll probably get. There's no aftermarket. There's no secondary market to sell it if it's not listed. So you can't get your money back if you need it. It's illiquid.
Right, so the first one is the emergency bucket, cash reserve bucket. Then you're going to have your income bucket. We're going to talk about what you should put in each one and what's appropriate for each bucket.
And that's fluid. It changes.
That's right. So income bucket. And then you've got your growth bucket. But you can also, hedge. Right. That's an inflation hedge. It's for growth. It's also to leave to heirs.
Absolutely.
So we're going to have all those 3 buckets. Now, I have seen before advisors split them into 4. They would even put a separate inheritance bucket. You could do that as well. But you can actually put those 2 last ones together because that's what your portfolio size is. So if you ever passed away, that's how much goes to your heirs.
Gifting and stuff.
Right.
So again, we're trying to keep it real simple and easy to do.
So we're bringing down to a 3-bucket strategy. You could make it 4 if you want a special inheritance bucket. Now, if you have any handicapped children or anything like that, you're going to have another bucket, okay? Because there's going to be a bucket to take care of them as well. So make sure you've got more. Normally you got 3 buckets. You could have 4 if certain circumstances dictate.
Or maybe special provisions for the 3rd bucket and such.
And that's when, everybody tries to sell you a trust because they can make a lot of money selling to you. Most people don't need it. But if you do have a handicapped child or whatever, you do need it.
And if you have
things you need to do.
I'll use a pet as an example. Like a pet, their work. You've got to keep them updated. You've got to stay on top of them.
We're talking about the plans, not the children.
Well, no, children at work too, and pets. But the trust. Once you have one, you've got to keep it updated. You've got to follow the guidelines. There's work involved.
Right. All right, let's talk about, first we'll talk about the easiest bucket, which is going to be the liquid bucket.
And also, if I may add, as we talk about, people ask us all the time, in what order, how do I do this? this is probably the first one we
First
address.
thing is going to be your emergency bucket. Now, remember that thing you've heard forever. You're supposed to have cash reserves of, they said, 3 to 6 months worth of
Forever.
Monthly expenses in cash.
Yep.
Does that make sense? They would be the exact same for a 30-year-old as a 60-year-old. No, you should have higher cash reserves as you get older, right? Things cost more, or, assisted living centers, all kinds of different things. Or your grandchild needs, bail money, whatever.
Margin for error grows as you get older.
That's right.
Exactly.
So what we use is 1 to 2 years worth of expenses in cash at retirement. That's what you're shooting for.
And 2 is a luxury. If you can have
That's
it, amen. But 1 year will work.
1 year for sure.
That's right.
It can't be 3 to 6 months for a 30-year-old and 3 to 6 months for a 70-year-old.
Absolutely.
Okay? So make sure you got to have that cash, and it could be emergencies for anything. Anything out there. One of my children is 32 years old, and I know at any given moment there could be something I'm going to have to pay for.
And you can't really use your 401k money for why. If you
Nope.
needed $60,000 for an emergency, you're going to have to take out $100 because you haven't paid taxes on it.
Right.
Pay your taxes to net the 60, so that each your savings also have the appropriate spot for them as well.
We've seen it where they put it in certain things. We've seen it in cash value life insurance, where sometimes cash is the best appropriate bucket. Okay, most appropriate bucket is cash. Now, what can you put? How long can you go? In other words, can you put a 5-year CD in your reserve bucket? Probably not ideal.
The long.
You keep things at 1 year or less. You could have a treasury bill. Treasury bills are 90-day government instruments, so 90 days or less, that's fine. 1 year CD, yeah, that'd be okay too. But make sure, sometimes right now, money markets are paying as much
I know,
as a 3-year CD.
CDs are so
Right.
low. That's right.
So look for those things. You can shop around. I saw some 2% money markets here recently, and they're not exactly, internet banks. Some of them are they're regular banks. And so it should be anything with 1 year or less maturity. It can't be real estate. That's not liquid. That's not easily. Even though you might say, well, I can sell a house pretty quickly, trust me, you can't. Right now you can because the market's going well.
And
if it goes against you, you can't.
Depending on the amount of deposit, it can be a fixed annuity only because you can get 10% of the total amount without penalty. So that 10%
Still going to be a shorter run.
It's got to be a shorter run, but I'm just saying there's some things that you can do there.
Right.
Some leeway.
And so that's the cash reserve bucket. Make sure you don't put anything but more cash and short-term instruments. They have to be extremely safe. No risk in this bucket. We'll talk about the rest of the buckets when we return. Remember, if you have any financial questions, you'd like to take advantage of our no-cost, no-obligation portfolio review, stress test, Social Security optimization, call us at 972-715-2424. Again, 972-715-2424. We got a break coming up. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Let me be clear. Guy is older. I'm the experienced one.
I'm thinking that announcer's biased. We're 2 of the most experienced advisors in the Metroplex. I like his bias, but I think he's a little biased.
All right. We're talking about the bucket strategy. We developed this bucket strategy. A lot of people are implementing certain variations of it. We make it a more simple bucket on purpose. Okay, it's easier to follow, it's easier to track, and easier to maintain. And so we first one we talked about is the cash bucket. Remember, the cash bucket needs to be cash or cash equivalents. Nothing more than, say, a year out, like a 1 year CD at the most.
No
should
risk.
be in that bucket. No risk. And if you have a question about if something's risky or not, call us and we'll tell you.
And I will add, if this 3-bucket strategy is too simple for you, we can complicate things.
That's right. We can make it
We
as
can make it
complicated as you
real
want.
difficult for you.
Now, the next one, and the second most important one. Remember, the most important one is having cash reserves. You have to have liquidity because you never know what you might need cash for. Second most important one is your income bucket.
And what is perfect for an income bucket? Hand in glove.
Well, anything that produces guaranteed income.
I would think. I'm talking about savings accounts. Retirement accounts, right? At 70 and a half, it's a forced income stream. You have to withdraw. The government wants their taxes. If you can save enough, if you can get your qualified money, your IRAs, your SEPs, your 403Bs, all of that, get enough put away there to take care of your income.
That's right.
You're in good shape.
People don't realize retirement accounts, like what you said, 401ks, 403Bs, 457s, are specifically designed for an income stream.
Absolutely.
They're specifically designed to deplete over your lifetime. So if you can use those and really multiply the amount of income that comes out of that thing, that makes your rest of your portfolio unencumbered by any expenses, will grow and grow and grow. And so you can actually allocate a portion to your portfolio and have more money throughout your entire life. Now, it's one of the hardest things I have to convince people is I'm going to take a piece out of here. We're going to make a huge income stream from it, and that's going to leave more money to your heirs and more money to you. Now, wait a minute. If I allocate something away from me, how's it going to give me more? We'll show you.
It's magic. Right. This is one of the secrets to be this right here.
That's right. When you magnify the amount of income you can get. Because remember, that 401k IRA, you have to start spending it at 70.5 whether you want to or not. They're going to increase the amount you have to spend every year until you die. And their goal is to deplete it by the time you die, because if you pass it on, it's going to take a long time to get their money back.
And there's many vehicles that you can use to do this, but think about it, it's fluid. Things change, and the best analogy I could give you would be stocks. Kodak Eastman, great investment. Not so much. Sears and Roebuck, they are great company.
Yeah, Montgomery Ward shouldn't be out of business, right?
Not so much. GE right now is falling under. So things change. So we've got bonds, CDs, fixed annuities.
And historically, you've used CDs and bonds.
That's
right?
correct.
And that can be because they're going to give you a guaranteed income stream. Now, be careful. Do not put junk bonds or high yield bonds in this income bucket, because they can get destroyed if interest rates go up like they're doing now. They can default exponentially. Make sure you don't do it. So what is good for an income bucket?
And they lose money quicker the further out they go.
That's right. The longer the maturity or the higher the yield,
yep,
and lower the quality, they have the most risk. Do not put it in there. Also, some real estate investments. You can be partial in this. You can have some real estate income. It can't be everything, though. It cannot be everything, because you don't know what real estate's going to do 10 years from now.
That's right.
The income bucket is for income, the most income you could possibly get. So a CD would pay guaranteed income, right?
Yes.
But they're only paying 1 or 2%. It's going to take more of those CDs to give you a certain
Don't have
income.
enough money to do it with 2%.
That's right. So then you've got bonds. Right now, 10-year bonds, 3 or 4%. You can use those. I like annuities. The low cost to no cost ones.
Fixed annuities,
That's
be
right.
real clear.
No variable annuities, fees are too high. I'm talking about low cost to no cost annuities, because they'll pay you so much more income per dollar. What is that? Why is that important? If I can get more income per dollar, it means I can put the least amount in my income bucket, because the income bucket is something I'm going to live on for the next 30 years. It is the most restrictive bucket. So do I want the most in the income bucket or the least in the income bucket? I want the least, so therefore I want to put the thing that produces the most income. Annuities for the last 20 years have produced more income per dollar than anything else.
And don't take it from us. Ibbotson and Schiller from the Schiller PE came out with an 18-page white paper explaining in detail why fixed annuities are the bond replacement for the foreseeable future. And again, briefly, as rates go up, current yields are staying the same in the bonds you hold. If you have to liquidate them to get to the cash, you have to sell it at a discount. So bonds, even safe bonds, are risky if you have to sell them before maturity for the foreseeable future.
So you got CDs, you got bonds you can use. We just talked about the risk of those. Fixed annuities, fixed annuity riders, those are all fantastic for the income bucket. Don't put real estate, things like that in there. We'll finish up the income bucket when we return. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
All right, we're talking about the bucket strategy today, how to produce a retirement bucket strategy, right? We talked about the first is your cash reserve bucket.
Which is done first,
priority. Nothing more than a year in maturity. CDs are fine, as long as they're less than a year. T-bills are fine. Money markets are fine. Cash, just regular cash is fine.
It's expensive because you don't earn anything on it, but you have to have that bucket.
Next most important bucket is your income bucket. It has to be something that guarantees income. Now, do dividend stocks guarantee dividends?
No.
No. Even though you could have a good dividend portfolio.
I was trying to think of a way to say yes, but I couldn't come up with one. They don't.
Dividends can go up, down. They can eliminate a dividend.
Underlying stock can vary.
Right. That's right. There's all kinds of different issues. That's why it can't be used now. Can you use it in your other bucket? Maybe, yeah, sure. It can be used in your growth bucket. but you can't use it in the income bucket. The income should be a guaranteed income stream, not a fluctuating income stream.
There's the deal. Lots of things you can put your money in that will generate income, and some will give you big promises for larger income. But what you need to include with income in the income bucket is what Victor just said, guaranteed income.
It's preferably increasing income.
That'd be awesome.
But you can't have an income stream that could go down. You know why? Because your bills aren't they don't fluctuate on the downside,
No,
really.
they're going up.
Yeah, they're usually going up with inflation, right?
Yep.
And even though they might, don't get me wrong, sometimes I'll spend extra one month and less the next month. I'm talking about when you average it all out, you got to have that minimum threshold no matter what. Now, what some people will do, they'll adjust the income bucket a little bit. Because remember, the income bucket's going to be your most restrictive bucket. It's going to pay all the bills. So it depend on how many bills you have and compared to how much savings you have, that'll be determine how large that bucket is.
That's right.
But you can, put some things in the income bucket once your expenses are paid. But some people will say only hard expenses coming out. In other words, your actual expenses are $5,000 a month, but travel and going to the hairdresser and all that's another $2,000. So they'll say, all right, my income bucket only produces $5,000 a month. Now, by the way, what also goes in your income bucket? Social Security.
That's right.
Pensions.
That's right.
Anything that has a guaranteed income stream goes in the income bucket. You add all those together, your bills should be paid. The mistake that I see most people making are this. They put everything in this growth bucket, and their bills aren't paid. In other words, if the growth bucket went down, they can't pay the bills.
I'm going to use the growth bucket to pay the bills.
That's right. Never use the growth bucket to pay the bills. It should always be the income bucket.
And what's the fancy term?
What?
When you use the growth bucket of fluctuating income to pay your bills?
Oh, sequence of returns risk.
That's right.
Is the one thing you're not thinking of. In other words, if you start out in retirement and lose money in the market the first few years and you still got bills coming out, you cannot recover. I call it the death. It's a death march. It's going to go down.
And there's another real important secret.
So at least your hard expenses go in the income bucket. You can put your other expenses outside of that. I call it my lifestyle bucket.
Yeah.
In other words, if I'm spending $10,000 a month, even though my bills are $5,000, I want $10,000 a month coming in every single month. I don't want the stock market, what it will or won't make, dictating my retirement.
I tell all my clients and my first meeting, and if you're out there listening, you'll be shaking your head up and down. My line is always this. Now, when we're trying to come up with a budget, we're not talking the penthouse, but we're not talking beans and bologna either. What's a comfortable number for you, which is lifestyle.
But the least you have in that income bucket is hard expenses. All right? I like my lifestyle because I want to maintain my lifestyle regardless of what the market does. But it is okay as long as you have the hard expenses. In other words, things go bad, you can just tighten up for a few months, right? So that's for you and your advisor or us to determine. All right, do you want hard expenses or all your expenses in that income bucket?
And you can't have all your money in the income. Even if it takes all your money to make your budget, you really got to think about maybe lowering the budget because you can't have all your money there either.
They said there's one or two things going to happen. Either you're going to come up with another $500,000 or you're going to reduce $1,000 a month in expenses.
That's right.
I hate having that conversation, but we're going to give you the honest thing.
That's right.
And while I'm finding, no, this other guy told me that I could do it. I go,
he's basing that 9% return every year.
I want to see that return they're talking about.
That's right.
Because they're telling you what you want to hear.
To get
the one thing we have never had a complaint in all these years, and I think why our show is still number one all these years, because we'll tell you the truth. I don't care what that person says. They're not looking out for your interest. They're looking out for their own because they're telling you exactly what you want to hear. You know how hard it is to get us to do something that's different than what you're doing? It's much easier to get you to stay with what you're doing.
Absolutely.
Much easier. I can give you 10 reasons to do something. Somebody gives you one negative thing, you're like, oh, I better keep it like it is. Because you're already familiar with that.
And it coincides with what you want to hear.
That's right. You want to hear it. You don't have to change anything.
That's right.
No, the other guy's just trying to scare you. I go, we're not trying to scare anybody. We're just telling you hard numbers. Here's what you got. Okay, so remember, income bucket has to be guaranteed income streams, not fluctuating with stock market like dividends or even preferred stocks. Those aren't guaranteed. I know it seems like they are. They're not. But you keep them to what they are. Now, you can put real estate, some things, in your income bucket. It just can't be the whole thing. Because you can't, once again, Your retirement can't be based on what the real estate market will or won't do, or what the stock market will or won't do.
And there's always an exception. We've got some clients that make 70,000 a month. I can think of one that makes like 120,000 a month on his properties. Commercial, they're all paid for. That's a completely different deal. So
that's called the high class problem. That's on the other end of the spectrum.
There's no. If anyone ever tells you there's an absolute, then you know you got to kind of.
I own rent houses. I'm not against real estate at all. I own rent houses, and they're fine. You can have them out there. Anybody really wants them, to be honest with you.
You might sell yours for the right amount of money.
All right, the last bucket, we'll just briefly get in that because we got a break coming up in a minute or so, is the growth bucket. So growth bucket this is the one that's going to pay for extra vacations. It's going to help with inflation because if you're getting $10,000 a month now, $10,000 a month is not by the same amount 20 years from now. It will not even come close. Look at your water bills the last 20, 30 years. Look at your taxes on your house.
Price of your car.
If you're old enough to be around here a while, I remember taxes on my house in Plano were like $1,500 a year.
Your last
now
car,
it's $12,000 a year.
Your last car probably costs more than your first house.
Oh, absolutely.
You're retired.
And so those kind of things, that's going to happen. So that's why the growth bucket is important. We're going to talk more and go in depth in that bucket after the break. Easy for you to say. Don't hesitate to call us. We'd be more than happy to show you the bucket strategy. Look at your portfolio to see if there's any holes in it.
Give you a free quote.
Free quote. Our number 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome. This is our show about the bucket strategy. There's a lot of different advisors use a variation of the bucket strategy. We like a very simplistic one. It's easy to follow, easy to maintain. Remember, your first one is your reserve, cash reserves. I'm going to do them from the most important to the least important.
And in order of, how you fill them.
Your income bucket would be next. Some people say I only want the hard expenses. Some people say I'd like all the expenses. That's up to you. But income bucket is extremely important. Otherwise, your retirement will be based on if the stock market makes money or not. You cannot have it based on what the stock market will or won't make, or what interest rates are or aren't.
When it tanks when you're in retirement, you're just hosed.
Now, if you have so many millions you can live on a 1% CD, there's nothing wrong with having a CD. You're losing to inflation. I get that, but you're rich. You don't care.
Yeah, call us. We'd like to visit with you.
That's right. We'll talk to you, too.
That's right.
The last bucket we're talking about is the growth bucket. We want this for us to send money to heirs if that's important to you. I have 4 children. I told my children, you're welcome to every dime I don't spend.
I know where that was going.
Hopefully I won't have to live with you. Just keep that in mind. You won't be changing my diaper. Just hope you don't have to do that. That would be good.
Here's one of the secrets. We talked about the secrets of the bucket strategy. If you've noticed, each one of the buckets has had a guideline as to how much to put in it. The liquidity bucket used to be 6 months. We said a year minimum. A year is good. 2 years is a luxury, but if you could do it, do it.
Absolutely.
The income bucket, what was the guideline? Well, how much money do you need guaranteed? You've got your Social Security, your pensions. You subtract that from what your expenses are. That's the gap that needs to be bridged. That's what you need to fund that bucket. So now we're in the hedge bucket, the growth bucket, the rule of thumb, the guideline. One of the secrets is you take your age and subtract it from 100, and the remainder is the most that you should have at risk. The easier way to say that is your age is the percentage that you should have safe. If you're 60, 60% of your money should be safe, then 40 can be in the market at the most.
It makes sense. When you're 80, you want 80% safe, not 80%.
Versus 20. So there's your guideline.
Right. And remember, you can use the other buckets for that allocation.
Yes.
If you've got $1 million in cash, that part counts as your safe bucket too.
That's nice.
All right.
Yeah. So, and you may be risk adverse, you don't want any in the market. I've seen that too.
That's up to you too. But the growth bucket, this is the one that helps with inflation. Average inflation the last 100 years has been like 3.5% or so. The last 10 years has been about a little less than 2.
Rates have been nothing.
That's right. So you have to plan on something like that. But even your money growing at 2 or 3% a year, the expenses, they're going to double and they're going to triple sometime during your lifetime.
In your retirement.
And so you got to account for that. Why is the stock market one of the best things to put in the growth bucket? Because long term, it is the only thing that is effectively beaten inflation long term. Everything else, sometimes it beats inflation, sometimes it doesn't, blah, blah. Stock markets pretty much universally have beaten inflation long term. But remember, we like stocks. I'm in these stocks, but I've already got the bills taken care of. I'm not relying on these stocks to spit out my monthly bill money. That's the mistake I see people make. They'll blend the buckets together or try to make, because they're more comfortable. They're more familiar with a dividend stock. So they're going to put it all in there and say, well, I don't listen to that dang Common Sense Investing show. I like this. It's okay to like whatever you want, but you run a real danger of going broke and screwing yourself if you don't have buckets that are separate. In other words, the income bucket pays off no matter what. You've got to have that bucket that pays no matter what you do.
And if you want to come in, we've got multiple cases. I don't know that we have time today, unfortunately. We're having so much fun. The show's kind of flown by. But we can show you actual case. We can do it with your numbers if you'd like. Right. But there's also other cases where we can show you where just allocating the appropriate amount to the income bucket really allows that third bucket to grow.
Right. We use, like I said, we use annuities a lot for the income bucket. The income bucket, because it pays so much income per dollar. And we can also show you the non-annuity one.
And it may be different in 10 years.
Right. You can use a bond. I said right now bonds can go in the income bucket. They're just not paying enough now. But what if bonds start paying 7%, 8% again? Well, then they're coming back in my income bucket.
Yep.
When interest rates settle down, you don't buy bonds when the interest rate's going up. But when that settles down, if I can get a 6, 7, 8% return on good bonds, I'm talking AAA bonds, they're back in the mix.
And if you've got millions of dollars and you need the tax break, we'll talk about tax-free munis. You got tax-free
munis
income.
Are fantastic.
Yeah.
Problem is, to get a good yield, you got to go out really long.
That's right.
But any kind of stocks you can have in there, but still use your normal allocations. Don't put 99% tech stocks or small cap. So even though your growth and legacy bucket, we'll call it growth legacy. So it's growth to help with inflation and legacy to leave to your heirs. Okay? The legacy bucket will, if it's important to you to leave money for heirs, even though I don't plan on leaving money to my heirs, I still want to have it. In other words, if I've got $10 million, I'd like to maintain this $10 million throughout my lifetime.
That's right.
Even though logically I know I can't run out because I'm only spending so much per year, I kind of like the idea psychologically of the money's just sitting there. It reminds me of when I was a kid. I said, if I'm going to save $1 million and I'll be rich.
Oh, yeah.
I had no idea. I was like, I'm going to live off the CD. I think at that time it was like 15%. I said, 150 grand a year. So I said, there's two ways I'm going to get rich. I'm going to make 100 grand a year, or I'm going to save $1 million. Well, what is that 100 grand a year? Is it rich now? It's not. Things change.
That's right.
That's why you got it. That's why it's so important to have that growth bucket. But that growth bucket only comes in after your income needs are already guaranteed.
And remember, each bucket has a guideline as to what you need to put there.
That's right. And there's nothing wrong. Remember that legacy bucket? You can also do other things. If you want to take a piece of that growth bucket, buy a life insurance policy. You can do that too for more legacy. Well, that's our show, folks. Remember, if you have any financial questions, like to take advantage of our no-cost, no-obligation portfolio review, stress test,
free quote,
Social Security optimization, any quote on anything, you call us at 972-715-2424. Again, 972-715-2424. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.